All right. Hello, everybody. We're having a little technical difficulties getting John Brick on board here. So sorry for the delay. Not quite sure what's happening with the Zoom, but the state we live in right now. So hopefully he'll be on soon. So the whole point of this webinar is to talk about the market outlook of 2023, whether there's going to be a recession going forward, what's happened so far, and how we're going to allocate the portfolio. So in the meantime, while John's coming on board, we're just going to talk a little bit about where we've been so far. So I'm your host, Stuart Kruse, President, CFO, CEO of Kruse Asset Management. John is our Chief Investment Officer, and we're delighted to have you on today. So let's talk about where we have been so far. And I'm going to share my screen. And actually, I'm going to do some of this on the fly here. So let's share my screen. So hopefully you guys can see the white charts up here on the screen. Oh, I was looking for SPX. So as you know, the market's done pretty well, and we've been kind of calling for a recession for quite some time. So here's our year-to-date returns of the S&P 500. We're up. Here's our friends from White Charts. We are up 15% year to date so far. And the question is, are we going to see a pullback? Are we going to see a follow through? Are we going to see a recession? Are we going to continue? Most times when the market's up this much, it continues to move forward. And the question is, what's going to happen? And so here we're at 15% on the upside, and how is the rest of the market done? So let's take a look at where we've been. We do know small caps haven't followed through. So here's our small cap. They're at 7%. Let's look at the AGG bonds. Here we go. We got a little double action here. Bonds are kind of flat on the year. International portfolio also up on the year. And SCHH, so how are the REITs doing on the year? So we've had a pretty robust market, and we've been calling for a pullback, but we think mostly of that's driven by AI. And we got John Brick on the line too here, who was able to join. Hey John, how you doing?
Good. Can you hear me?
I can hear you now.
Great.
Awesome. Yeah, sorry about the confusion, and glad to have you on board. Make sure that there's nobody else that we need to admit. I think everybody's in. Okay. So it's just going over the current year progress and the asset classes that we've seen. Total returns of the S&P 500, small cap hasn't had the same follow through. International's up 12% year to date. REITs are slightly positive. What I found interesting, though, is if we go back, so we've had some pretty nice returns. Let's get rid of this total return. But if you go back throughout the year, just 1 year later, when we called for the pullback of the market, when the market was too expensive, and we said, hey, well, looks like we're at a spot where maybe it's getting too frothy and we need to pull back. From there, all numbers are negative, and look like they're about to kind of get to the same spot as we were before. So we've kind of round tripped it from the beginning of last year to here, but it still implies that all the multiples are pretty expensive. Any commentary on that, John?
One operationally, you might have to, if you can, my screen's cut off. I don't know if everyone else can see the right side of the graph. But that could just be me. I could be all my technology lag today. it looks right on your side. It could
It
be
does
right.
looks good on my side.
Okay. All good.
All right.
Fire away.
All right. There was a question about follow through. So let's take a look at some of these sectors. So as everybody knows, all the craze is the AI and technology ETF is up 40% year to date right now. And so some of the bears have been complaining about lack of follow through, and we do have follow through in consumer discretionary and industrials. So we're seeing some, but the whole market's up 15%. So the top three sectors, technology is driving this boat, of course, but everything else, if we start looking at the rest of the sectors that are in the S&P 500, pretty lackluster and some negative. So clearly there are two sectors driving the entire economy, and that's consumer discretionary and technology. And if I look at what's in consumer discretionary, well, actually, let's just even do that. We'll look at the XLY.
Tesla.
Exactly.
Spoiler alert.
So what's
Tesla.
really driving this? Amazon and Tesla. So these are make up almost 50% of consumer discretionary. So it's tech. So it's not the consumer, it's still tech, right? So the real question are we getting market follow through? And again, to run that same exercise, if I look back 1 year, energy's done really well, but everything else has basically been lackluster, and it's round tripped, and most of the market is still negative. So while we've gotten a lot of catalysts and a lot of momentum from AI, and I don't see that stopping anytime soon, the overall market is traditionally not really that healthy.
We could look at IWM versus S&P too to show IWM is only up a fraction. A broader index, a broader look at the market, if you wanted to pull that up.
IWM versus the
the Russell. Yeah, can help to show some of the discrepancy.
Right.
If not, no worries.
You can see that though, right, John? Or no?
I can see IWM. Yep. There it is. Okay.
So with that thought, so we made a market call back in early 2022 that the market was frothy, expensive, and then it started to break down. So we followed the momentum, followed the money, and we sidestepped a lot of the decline. Because of the inversion of the yield curve, and we're going to talk about some of that a little bit more, we were still saying that the market was going to be weak, and now we've had this big AI kind of revolution that's driven a lot of tech. But with those thoughts in place, we made some moves in the marketplace, and John's going to talk about the asset allocation that we're currently holding right now. So, John, why don't you talk a little bit about what we're doing right now with the asset allocation? We'll talk about the future allocation in a second.
Of course. So we started off a year ago pretty defensive. We're going through 2022, and we had a lot of negative catalysts that even fell into 2023 with the banks blowing up, a few banks failing. So we've remained defensive the whole time. And I'll start by reiterating that we have a massive position of treasuries across the board that are yielding over 5%. So that's a risk-free instrument. 5%, you can't go wrong. But along the way, we've also have our core ETF model, and we've been trying to build into that to find very risk-adjusted, favorable positions. And so a couple examples that we've been investing in are PTY, PDI, and
we are getting a lot of fixed income exposure. So you have fixed income level risk. As you know, like fixed income really fell off quite a bit in 2022 with rising interest rates. And now that there are probably a lot fewer rises ahead of us than there are in our past, it's unlikely that you're going to have a really big pullback in fixed income. So we're getting great returns in those kind of asset classes without a lot of the risk. All right, we got you back now. Try again.
All right. My next topic, in case I fall off, I was going to hit on the 3 ETFs that we're trying to play, the picks and shovels of AI. So I'll talk slow just in case I start to lag. But as NVIDIA has become the poster child for AI and has become increasingly expensive, the price to sales of that stock has gone up 200%. So the same stock, net of all earnings growth, is double that. So if you own your house, you bought it for 400, 2 weeks later, literally in 2 weeks, NVIDIA, your house is now worth 800,000. It just doubled in valuation. So things like that are interesting from a trading perspective, but we don't really want to have a business of chasing, right? Look at that stock. So we understand that the AI price to sales, right?
Sales of NVIDIA. So even in some of its heyday, we're looking at 15 times sales. Right now, it's trading at 41 times sales. Like a normal number is like 2. That's a normal number.
NVIDIA is absolutely following the footsteps of the dot-com bubble. It's the same craze. You buy the poster child, the valuation's impossible to live up to over time. But regardless, people want the short-term trading craze. So we've tried we obviously would have loved to own this, but we didn't. But what we're trying to do now is, call a spade and say there is an AI craze going on, and how do we play it? And so three stocks that have better valuations and better technical setups that we've bought into are Amazon, which everyone knows, CTH, and ACN. One of them, the big name is Accenture in the space, and Cognizant Technologies. What these companies do is they basically, obviously Amazon is Amazon, but the other two are what we consider the.
All right, try again. You want to just shut off your video so that we just hear your voice?
Sure. CTSH, you got it, bingo. So these stocks are really going to be helpful from a consulting standpoint. They're technically breaking out, have strong earnings and cash flow, and should be able to have a big tailwind from technology. If you can still hear me. All right. Yep. So we've done that. So if you look at our portfolio with a risk-free 10%, 5% treasury bonds, some of the fixed income ETFs that have equity like upside, but pretty low downside in our opinion, given a year's time frame, and some of these tech stocks, we feel pretty favorable about the ETF portion and kind of the liquid section of our portfolios. I think I can pivot to some of the structured notes, which we also find very attractive in the space. So one of the things that we've done is we've put structured notes in accounts called the catapult note. And so the catapult note is something that is kind of like a call option. If in 1 year the stock market's positive or up, which in this case it most likely will be given the rise, the note gets called at 14%. So you make 14% in 1 year. The downside of the note is only if the market's up 16 or 18. I think I froze again. I'll keep talking just in case.
Yeah, you're good.
Okay. All right, great. So the downside is that the S&P is up, a material amount more than that, which, you make 14%, you're still okay. But if not, the S&P somehow ends up down, this note for the next 4 years kicks into a 200% upside growth note. So let's say we go through a little bit of a rough patch over the next 6 to 9 months, but the next 3 years are a bull market. You're now participating in 200% of the upside for the next 3 to 4 years, depending on when the bear market is over. So we think that was incredibly attractive risk to rewards, and on the downside, you have, I believe it was a 20% hard barrier. So you're protecting on the downside if in 5 years the market drops. So just, for lack of better words, a no-brainer investment from us that we found, and we're able to use some of the volatility that the market was giving us to price a really attractive note. On a similar note, the volatility helped us create 2 income notes that I think are very timely. Both of them are 12 months, pay monthly income. And the income stream on an annualized basis is 15% paid monthly. So you get about a 1.25% a month, give or take the decimal points. So the two structured notes that are underneath, or the 2 stocks that are underneath the structured notes, one of them was Schwab, SCHW, and the other one was KRE. So basically what we did was we took the regional banking crisis when the KRE dropped some 20 or 30%. There you go. And we wrote a structured note that collected 15, like I said, the 15% income if the KRE over the next 12 months does not drop another 50%, 50. That would bring the regional banking ETF and sector back to below the 2008 lows, something that we just don't see happening. So unless every regional bank closes up in the next 9 months, we have a very attractive 15% income note, which is just very strongly favored. Same thing for Charles Schwab. It's a predominant player in the space for wealth managers. We use it. Everyone else in the RIA space uses it to some degree. They're gobbling up market share. And because of this issue, the stock did drop, what is that, 50 some percent, maybe? I don't remember off the top of my head, but it looks like 50%, maybe 30%. But we did the same thing. We put an income note in accounts that generates 15% interest over the next 12 months if Charles Schwab doesn't drop another 50%. I don't think that's likely. So we can find, and we're finding very attractive ways to create income on a total return basis, risk adjusted very favorably, and we don't have to try to fight the AI craze and become traders. So as you saw earlier, over the last 1 year, the Russell is up 3%, right? We're talking about ETFs and structured notes that all have 14, 10, 15% total return streams over the next year if done right. So we're very comfortable with where we stand. We have a lot of diversified income streams coming in. And if the market does continue to be tough from here, like it was in 2022, we're going to materially outperform, and we're feeling really good. So me and my lag, we'll leave it there.
Okay. So let me jump back into the recession itself. Are we going to see a recession? And I'm going to spare all the 10-year, 2-year kind of discussion. We talked about this a little bit, but I've done some additional work on this. So here is the 10-year minus the 2-year Treasury spread. As you can see, every time this spread drops to negative, which means the yield curve is inverted, every time we've seen a recession, which is indicated by these gray bands. So drop below this zero, here's the 0 mark right there. That's the 0 mark. Anytime that purple line goes below 0, we saw a recession. Below 0, recession, below 0, recession, below 0, recession, etc. So then I did some additional work on this and just kind of show you the numbers here. So 10-year spread, Treasury spread, core inflation, U.S. rates. Here's the S&P 500 levels. Here's where the spread is inverted. And the bands, you're going to see gray bands here at some point. There they are. Gray bands, that's the recession area. Okay. And we checked out, I looked at the S&P change. So I did a little math around this. So if we look at this chart, here's when the 2 minus 10-year inverted. On the date, here are the dates. And here's when it uninverted. All right. Here's the days of the inversion. This was 623 days. So coming up on 2 years, a year. So the average time that the market stays inverted was 469 days. We're at 357. These were max inversions and the average length of the inversion. So our max inversion right now is 1%, which we've seen worse. And if I look at the inversion curve, we're at the max right this second. So does that mean that's the entire max of the inversion? I would suggest no. Normally it's very unlikely that at any given point in time, you're going to be at the tip top. So we're at the current max. I would suggest we're going to invert even more. Why does any of this matter? Well, I also looked at the start of the recessions that we've seen and the end of the recessions and plotted those out. So these lengths of the recessions, 182 days, 400, 200, average around 340 days. And if I looked at a number, the start of the inversion, so that's here, versus the end of the inversion or the start of the inversion and the recession, you have an average of when the inversion starts between when the recession starts. And that difference is around 480 days. So that would take us to November. If we said, when did this current inversion start? And 481 days from that point is November 1st. So it makes a lot of sense that we haven't actually seen a recession yet, because it's unlikely for us to have seen one until November. And if I look at what happens during the inversion and during a recession, well, we're currently inverted, but we're not in a recession. So the max drawdown in an inversion of the last 5 inversions has been 8.4%, or that on average. And we had 8.1. The max gain during the inversions has averaged around 10, with highs between 12 and 11. We're at 14. Well, there's a high of 15% here. So we're at 14. So this seems to be kind of following the playbook of the inversion playbook. Max drawdown of 8%, max run up of 14. That's well within what we've seen over the last 5 inversions. And this goes back to the 70s. During the recession, if we do see one, max gain during a recession averages around 4.5%. And the drawdown is around 24%. So that's what we're kind of looking for. It looks like the run-up during the inversion has played itself out. And it looks like when we get the recession, which may not come for a couple months, you're still going to have some weakness in the market. So if I look at this and try and compare some of this information with our friends from JP Morgan, the guides in the market, we're back to being, here's a valuation measure, we're back to being almost as expensive as we were before. This is a standard deviation away from the average returns. And let's just look at a couple other fun little charts that I thought were very interesting. So 11, weight of the top 10 stocks in the S&P 500. We're back to where we were when we called that overweight valuation. John mentioned the Russell. Here's the percent of non-profitable companies in the Russell, which is on a rise. That is very recessionary indicating. If I look at the valuations of company, average valuation, current PE as a percentage of the 20-year average. Growth is way overvalued, and value undervalued, and small cap undervalued. Okay, so again, we're getting to extremely frothy periods of time. Market inflection points, we covered this in the last recession, but at the end of the day, having low unemployment does not stop you from going into recession. The purple line is unemployment of the last 9 recessions. It was low and then spiked, low, spiked, low, spiked, low, spiked, every single time, low spike. So the fact that you have low unemployment like we have now is not a preventer of a recession. Capital market spending, way down on a downturn. Household debt. So here's another thing that we're talking about is, can all the cash that was thrown into the economy itself is probably leading towards this run up in the S&P, but it looks like it's starting to run out. So household debt service, it was way low during those COVID stimulus, and we're back up to where we've normally seen, and then flows into early delinquency is up and kind of at a near-term high. So again, these are recessionary indicators. Savings rate. Here's excessive savings rate that the economy had seen during the COVID period of time. And now it's basically run out of money. So revolving consumer credit outstanding is on the rise. All these things, we're basically waiting for an excess amount of cash to work its way through the system before the effects of these higher interest rates and the Fed funds moves will take into effect. So that kind of is in alignment with November. So right now we're hearing a lot of rhetoric like, oh, there won't be a recession, AI is driving everything, but the numbers line up that just going to come in the second half of the year, maybe early 2004. What other kind of fun charts do we have with these guys? So core CPI, again, we go kind of by the core, which is this dark line, and it's extremely persistent. While the headlines has been declining, which is what you're hearing about, the core has been pretty consistent and well above long-term averages. And here are the makeup of the inflation components. Let's focus on the core. Do we think education and other services and recreational services, they've all been pretty steady? So the real question is, are the big portion of transportation, is that going to actually be the way that we cut core inflation? Maybe, but energy prices have been rising more recently. So again, that's probably not likely that you're going to see a reduction in this red bar, which is transportation services. So where's the total reduction of inflation going to come from in the future? I don't know. That's what we're fighting, and I don't know. So here's the final kind of, I don't know, not nail in the coffin, but here's the projection of the Fed and the interest rates. So here's the Fed funds rate. And now the economists are projecting it for it to drop lower, right? They're saying, okay, we're going to have maybe another Fed funds raise, and then we're going to see a decline in this interest rate. Now, I don't know how we see that unless we look at something that's what I find pretty interesting. I'm going to put on right now, here's the federal funds rate. And the reason why the federal funds rate declines is because we're about to head into recession. So if you're calling for the Fed funds rate to fall, you're basically calling for a recession. You can't have it both ways. You can't have a soft landing and the Fed funds rate decline. You're going to have one or the other. So every single time you see a recession or a recession coming, and you're projecting this downturn, that's because of the recession. So it's coming. It's just not here yet. All right. So what we're planning on doing is we're going to ride this wave for as long as we can until we see the economic indicators turning south again. So maybe it'll be another 5 or 6 months. John, any comments on asset allocation?
I think I love the way you worded that before. It's coming. We don't know when. And some good evidence. The rate cuts and the rate hike and the recession paradox. It's greatly worded. A few other things about what we're looking at in the horizon. We talked about the fixed income ETFs. I think there's a lot of closed-end muni ETFs that are going to be pretty attractive in this environment if rates do fall. And, for high income earners, we're starting to look at some of that. I think another interesting thing in this environment, given the rates are so high and may fall, are looking at corporate bonds. So we've been trying to cherry pick some corporate bonds out of the market in place of treasury bonds. So treasury bonds have yielded between 5.2 and up to 5.6 based on the duration and the time of when we've entered. But there's a lot of bonds that are also 6 to 6.5% or higher, and they don't come around every so often, but they do pop up. And so we've been trying to watch out for those. And if we start sprinkling some of those in there, like AMC Networks, we've had some WP Carry, which is a triple net lease REIT company, some others out in the space, Occidental Petroleum. We've started to find some really interesting bonds. It's just not at the scale that we can put in every account in replacing treasuries. But I think that's a very interesting thing. And as spreads starting to widen in a recession period, those yields may go a little higher temporarily, just to show kind of the value of those bonds. And when rates get cut and people rush to the yield, the chase yield, you're going to get a huge total return yield on those corporate bonds.
Yeah.
So we're looking at that. I would also say really quickly that we are looking at some other very interesting private alternative assets. So we really like the ones we have now. We have real estate debt yielding about 7%. We also have a CNL, Strategic Income Fund, which is basically owning of 12 to 13 businesses. I think they just tacked on the 13th business, and then over 25 smaller tack-on businesses inside of those. And so it's basically like a Berkshire Hathaway of private businesses, where you get a total return of targeting of 12%. We love that business, still love that. But going forward, we're trying to find other private equity businesses that are similar to give you an alternative, differentiated, and diversified income stream. Again, targeting that 12 and somebody's up to 15%. So over the next 6 months, we have some meetings coming up with clients. We'll probably be talking about some more private equity ideas that we've been looking at. What else? Those are the two main things: muni bonds. I could say that we've talked about trying to implement a little bit more trading. Right. So September 1st, I rebel from TD Ameritrade, which is their crown jewel, I guess you could say, of trading software. That is coming from TD Ameritrade to Schwab, and we're pretty excited about that long term. It may give us the potential to try to be a little bit more tactical in trading ideas, right? And so when this tech AI bubble comes and we see some quick trades we want to make, we're thinking we have the possibility of trying to take advantage of some of these. Obviously, no promises, and we don't want to build a business on trading, but we could see some of that going forward. And so that's interesting to think about long term. So muni bonds, more private alternatives, and maybe some trades in there. That's all I got.
And yeah, I mean, you hired us to be more nimble, so we definitely want to be tactical in our allocation. And if we think the market's going to continue to rise until we see a recession, we still are calling for this recession. I was listening to Kramer on TV, and he seems to be much more of like, I'm going to agree with whatever's happening in the world right now, and it should be obvious to everybody. But what we think is obvious is there is something coming. It's going to be a little bit wild. So we're going to try and take advantage of the upswing. We've had a little bit more leaning into some more equities in both 401k allocations and their allocations with us, so that we can be part of this return. We're still reducing the risk, trying to be as efficient as possible. That's what we spend our days and nights on thinking about, is how can I make your portfolio as efficient as possible? So not taking on the risk of an NVIDIA, which could also have a humongous decline, but getting those returns in the most efficient way we can. Maybe that's through fixed income, because if we do see a decline in interest rates, as John said, eventually, and probably not a lot more of incline or increases, then those bonds are going to have much better returns, right? Drop of interest rates, higher rate of bond returns. So when interest rates were shooting up through the roof, bonds got crushed. So we can take the opposite of that approach. I did want to touch base on one thing, maybe not everybody's aware, but we do want to make sure everybody is aware, is that we do run a virtual family office here at Kruse Asset Management. So not only do we invest money in a technical way, and that's what our focal point on, and that's kind of our lane, is how do we invest money in the most efficient way possible using math and statistics, so that our biases are minimized, and that we can take advantage of the opportunities that the market gives us without us second guessing things. Most of our clients need additional services that maybe we don't offer, but we have a team-based approach where we have more than 50 different other professionals on our platform that we can rely on. We bring them in as if you have your own virtual family office, work with your CPA, work with those outside of experts, so that we can act accordingly as a fiduciary for you. When I was at a brokerage firm, we weren't allowed to work with other experts because they couldn't control the other experts. But as a fiduciary, where we have to put our client's best interest first, I don't know how you don't work with other experts. The only way I can give you your best solution is to work as a team with the people that you work with. Clearly, much better working as a team and talking about your solutions for you than working as an individual trying to protect my fiefdom, right? So we'll definitely take you through these diagnostic tools called the CIQ and try to be much more proactive with you and make sure that we are maximizing your wealth and taking advantage of all the tax mitigation strategies that are available to you and that makes sense for you. Any questions or comments on that, John?
No questions, but comments of that. Everything you said, dead on, and we're very confident that we, have a solid foundation and portfolio management, team-based model, estate planning, full steam ahead. Yep.
So yeah, part of that virtual family office, I guess I should have mentioned that advanced estate planning techniques, tax mitigation strategies, buy-sell agreements with your partner if you have a business, cost segregation, again, 50 plus different areas of finance we can touch on to help maximize your wealth and protect your family at the end of the day. That's what our mission is. Our mission is to basically look after the accumulation of wealth that you've spent your lifetime creating in the form of dollars and cents and investments, and so that you and your family can live comfortably, safely in the way that you want it. So we understand that our goal and our job is to be your stewards and to help protect those assets in your life's work. And we take that very, very seriously. John,
awesome.
any last wrap-up comments?
Partially one that's apologies for the lag and the bad quality, but no, I think I'm good. Any questions? You know how to get a hold of us, and onward and upward.
That's right. So we're doing our client review meetings the next couple of weeks, but this will be recorded. We'll send it out to everybody once it's finished. And we have quarterly market outlook at September 5th, I think, and maybe it's probably October 5th, sorry. And then again in January. All right. As John said, any other questions, please reach out to us. And we appreciate your trust and your loyalty. And we look forward to continuing to work hard to maintain that trust. Stuart Kruse, John Brick, signing off.
John Brick. Bye.